A very common question we get from our community is how we go about finding good trade ideas. Now, it's important to understand that there are hundreds of ways to find trade ideas, right? Apparently, YouTube is full of ideas on how you can generate good ones. You can pay someone $1,000 to spend 2 days teaching you how to find trades using candlesticks, or pay someone else $2,000 to teach you how to draw lines on a chart and teach you how to find trade ideas that way. Or perhaps you can pay someone $3,000 to teach you how to add 2 simple moving averages to a chart and teach you how to find trade ideas when those two cross over. Now, I'm sure every now and again these types of strategies and methods will generate a winning trade idea here and there. But I don't want to spend all my time sitting in front of the screen looking for barely profitable trade ideas. We want to look for the highest probability ones, not ones that waste our time. We want to trade the ideas that offer us a good and clear edge to trade with. Now, beyond contrary belief, that candlestick pattern course, or that support and resistance course, or that moving average crossover course just won't give you that. Yes, they'll generate many trade ideas, but there are trade ideas and then there are high probability trade ideas. And in this video, we'll focus on the latter. Now, before I continue, I can already feel the hate coming from all the die-hard candlestick and moving average experts out there. So before you write me that hate mail, yes, I do use technical analysis in my trading almost every single day, but I use it in the right context for what it was designed for. And if you can put aside that anger for just a few seconds, I'll actually go over exactly what the technicals do and where it fits into a good process a little bit later in this video. So without further ado, let's see what process we use to find high probability trade ideas. We call it our 3-step analysis process. Now, if these 3 steps seem simple, that's the point. But please don't let the simplicity fool you though. Its simplicity means that it's repeatable. And if it's used correctly, it's very effective at generating high probability trade opportunities. So let's take a closer look at the process. The first step in the process is the baseline. In a nutshell, we need to know what is expected for an asset and the risk event that we are trying to trade. Whether it's for an economic data point or a central bank event really doesn't matter. The first step is figuring out what is the expectations and what is priced in for that event before it happens. Then, looking at step 2. Step 2 is where we find out the surprise factor. Once we've done step 1 and know what the baseline expectations are, we can analyze what needs to happen to really surprise the markets. Remember, the markets is a discounting mechanism, meaning that it'll price things in before they happen. So if markets are expecting a central bank to hike rates, for example, markets won't wait for that hike to actually price that in. They will price it in before the actual hike happens. So if markets are expecting a central bank to hike rates, markets won't wait for that hike to actually happen before pricing in the hike. Markets will price in that hike before it happens. So if we know what is expected, what the baseline is, we can figure out what scenarios or outcomes will really surprise the markets. For example, let's say we know that markets have been pricing in a hike from a central bank. That's our baseline. If the central bank then decides not to go ahead with the hike that is already priced in, that creates a big surprise for the markets, and that is what we want to take advantage of. That brings us to the third step, which is assessing how any of the possible surprise scenarios that we analyzed in step 2 could potentially change the bigger picture. For example, if we build 2 plausible surprise scenarios for a central bank event, but neither of those 2 surprise outcomes will be enough to change the bigger picture outlook for that particular central bank, then any surprise will only be worth a short-term trade. But if any surprise outcome is so significant that it changes the bigger picture outlook for that currency or for that central bank, then that could be a bigger or a longer time horizon trade. So with the basics outlined, let's take a look at how we use this to generate a high probability trade idea. A really good example was the Swiss National Bank policy decision that took place on the 22nd of September 2022. This was one of the clearest, cleanest and simplest FX opportunities in the second half of 2022. In terms of probability, it just doesn't get much better than this one. So yes, this is a cherry-picked example, but it was one of our best trades of 2022 and well worth a look. So let's take a look and see how we prepared for this event. Let's once again start with the baseline. What was the baseline going into this event? Well, going into the 2022 September policy decision for the SNB, money markets had already priced in 100 basis points worth of tightening for the SNB for that meeting. Taking a look at the money market data, we can see that going into the meeting, the market was getting more and more aggressive in their expectations, pricing in 66 basis points of tightening at the start of September and moving higher and higher all the way up to 100 basis points on the day of the meeting. Now at 100 basis points, it meant that money markets was placing around a 99% chance of a 100 basis point hike. So going to step 2. With 100 basis points already priced and expected, it would have taken a 75 basis point hike to surprise on the dovish side and a 125 basis point hike to surprise on the hawkish side. Now, both of these two would have been tradable, but given how stretched the Swiss franc was looking at that time, we preferred to sell the Swiss franc on a 75 basis point hike surprise. So what about step number 3? The bigger picture. Now, whether we got either of those two rate surprises, a 75 or a 125, it would not have been enough to change the bigger picture, not for the Swiss franc or for the SNB. And that meant that we were only interested in a short-term trade. So, what was the outcome at that meeting? Well, in the end, the bank surprised with a 75 basis point dovish hike and signaled a slightly less aggressive stance for additional hikes compared to their June meeting. Now keep in mind, markets had already priced in a 100 basis point hike for that September meeting. That meant that the 75 basis point hike meant that money markets and sterling markets had to very quickly price out that additional 25 basis points it had already priced in going into the meeting. That repricing offered a no-brainer, high conviction, high probability trade opportunity to sell the Swiss franc. Now after hearing it was a 75 hike over our audio squawk, there wasn't any second guessing on what to do. There wasn't any wondering whether it was a trade. We knew immediately it was a trade. Our 3-step analysis process told us that a 75 basis point hike was a sell on the Swiss franc. So we just pulled the trigger the moment we heard it was a 75. We jumped in about 10 seconds after the announcement and we got a pretty good fill for that trade. Now for all of the die-hard candlestick makers and average crossover traders out there, this is where the technicals comes into play. Our fundamental 3-step analysis process gave us the pair as well as the trade direction. So after that gave us a clear buy trade on the pound Swiss, for example, we then used the technicals to tell us where to get out of that trade. Now we kept this one really simple and just used the daily classic pivot point levels as our areas to take profit off the table. That meant taking profit at the daily, the R1, the R2 pivot, as well as around 110.80. And after that, we moved our stop to break even, which was later taken out just below the R2 pivot. Now, instead of the basic pivot points, you could have used your candlestick patterns, your moving averages, your Fibonacci levels, or whatever else it is that helps you find markers on the charts to use. The point here is, though, that I didn't rely on any indicators to tell me that this was a buy. No technical analysis indicator would have been able to get me into that trade at the right time for the right reason. It was the process that gave us the trade. And after the process gave us our trade, only then did we use the technicals to help us get out of the trade at the right spots. Now, yes, I know this was a cherry-picked trade idea, like I mentioned before, but a great example of how this process works to find high probability trade ideas. So I hope this has been helpful, and make sure to check out the rest of our channel for more useful videos. Until then, happy trading.